today's the main focus is going to be multi-time frame market structure, and over the following next lessons in the series, we're going to supply demand, liquidity, and all this stuff that's coming from that. So let's recap what we did. We tried to link that with a link. This we miss it. Recap. So essentially, we get our basic market structure. Bracket is bullish, makes higher highs and higher lows. The swing point is going to be the lowest point that caused the break of the high. Then the bullish market, the bearish markets, that new swing high is always the high point that led to the break of structure. That becomes our strong high. We expect price to pull back, but not to break our strong high. Then they continue and target that weak low. Okay, covered that in the previous lesson. I'll introduce you to more of an advanced concept, still based on one time frame, where we have three types of structure on that one time frame. We got those larger swing ranges. How do we deal with complex price action that will develop between the current swing high and swing low? And this is how we tackle it. So when we get the internal structure shifting trend, then we get that high boss. What does that signal? It signals the start of a swing pullback. And then we can follow that internal structure bullish. Once it shifts bearish, what does this signal? Now it signals the end of the swing pullback, and now we can follow that bearish internal structure the whole way down to target what? To target the weak swing low. Okay. One further layer of structure is the fractal structure, and what does a signal? Signals the start of an end of an internal pullback. So those little tiny aggressive shifts in structure, like signals the start of the internal pullback, false reversal, got a IBOS. What do we expect of an IBOS? Internal pullback, fractal structure signals that internal pullback is dying. Now we can trade it, only trade it until that's strong low because we expect it to hold. So how can we signal that it's finished? We look for that bullish change of character, fractal change in trend that signals the pullback, and now we can target that weak high. So same process and again, and that's the framework we follow. And this is with Carl in depth in the previous lesson. Okay, so that alone, we can literally almost see multi-time frame analysis without even. We wouldn't want to sell for that. We want to go to the next levels, and we can bring multi-time frames together and combine it with the three types of structure. In my opinion, that is almost a holy grail in trading. Being on the right side of the market, way not more than not. Right. So MTF analysis, multi-time frame analysis. So this is the easiest way to think about it. It's the candlestick chart. Imagine that you're looking at one weekly candle that's going to be made up of 5 daily candles on a daily chart. So it's 5 trading days a week, and that weekly candle going to be made up of 4-hour candles and 1-hour candles. Lower the time frame you go, the more price action makes up with that candle on the higher time frame. Time is power. Monthly candle more important than weekly. Weekly more powerful than daily. Weekly 4-hour, and the lower you go. So higher the time frame, the more significance, the more liquidity, the more orders, the more money is being taken to form the price action in the time frame. The lower you go, the more noise, randomness you will be prepared with. So you get this iceberg, right? Candle in a time frame is made up of tons of price action in the lower time frame. So it's what we don't see on the iceberg. If you look at the price action, you look at a 5-minute chart, that makes up for the 4-hour candle looks. So now in the bullish market, a series of higher highs and higher lows is what makes our price. Got break of structure, we expect a pullback, right? So that bullish trend is made up of a series of runs. Run, pullback is a run, pressure run, and so on and so forth. So that overall trend is made up of a series of runs, right? Why is it important? So this is the key to understanding the complexity of what you're about to learn. When you truly understand what is this, makes all the difference. When I was told this by Michael, kind of took me a while to get my head around it. But when you get the whole puzzle, most time frame structure, it really makes sense. So a run in a higher time frame is a trend on the lower time frame. A run on a higher time frame is a trend on the lower time frame. So this is really important. Uh, hmm? Let me show you on the chart what if this makes more sense. So what I want to do now is just think about string structure. Don't worry about 3 types of structure, anything. So let's just think swing structure. So in here, in this diagram, we have two time frames. The thick black line is just higher time frame. Let's call it a 4-hour chart. It's easy to remember. The thin gray line is one time frame below. Let's call it the M15, 15-minute chart. So a run on a higher time frame is a trend on a lower time frame. So let's say the 4-hour chart run a bullish market, higher highs, higher lows, higher highs, higher lows, shifts bearish for a bit, got a shift of structure, and it is bullish again and higher highs, higher lows, higher highs. Simple swing structure. Now, each of those legs, that's a run to the upside, that's a pullback to the downside, we call it a run, that's a run, that's a run. If we ever to look at each individual run, we go down on the lower time frame, what exactly are you going to be? It's going to be a trend. So a run on a higher time frame, this run to the upside is going to be a trend on the lower time frame. So just this, let's just focus on this leg. That's one straight run. If we jump to M15, we're going to see higher high, high low, higher high, higher low, higher high. Why is that important? What does that matter? Well, it helps us to understand the relationship between two time frames. So when the 4-hour, let's say, is having that bullish run, the objective of the lower time frame, think about its mission, is to fulfill your objective of the higher time frame. So the M15 is going to form that bullish trend in order for the 4-hour to do its pro trend or run. At some point, we know that 4 hours is going to have a pullback. So what is the lower time frame going to do? Lower time frame is going to change trend in order to facilitate that pullback. So we're looking at the M15, and we see that the M15 then breaks the low and creates a market structure eyeballs. When we have a lower low, we now know that we're in the 4-hour pullback phase. We can follow that bearish M15 trend, can go shorts, and we have to realize that that bearish trend on the M15 is not going to last for very long. Why is it not going to last for very long? Because we're only playing the 4-hour pullback. So we got to realize that as soon as that is over, what is the M15 going to do? The M15 is going to shift bullish because it's fulfilling this objective of a pullback. So when the 4-hour pullback is finished, the M15 can now shift bullish again to do what? To do the next pro trend run on a 4-hour chart. Then we can follow the M15 to at least start at this high and potentially a bit beyond. Now, after a 4-hour break of structure, what do we expect? We expect a 4-hour pullback. So what can we do to signal that 4-hour pullback is starting? We can look at the lower time frame, M15, and when you see the M15 shifting bearish, H4 is dropping, pullback, and the same thing over and over again. We follow it for a little bit. We know that's going to last for a little long because it's just a 4-hour pullback. When a 4-hour pulls back, it shifts bullish again and rings and repeat, and again and again and again and again. That's just the time frames. Let's say the 4-hour and the M15. Those 4-hour runs are made of M15 trends. But then if you think about the daily chart, right? Daily chart's going to have one big pro trend run like this. It's made up of a 4-hour trend. That daily one leg is made up for a 4-hour trend, and then there's a lot of M15 trends. It's a lot. So one day leg, and then we have daily pullback. So when we're having a daily swing, a pullback, it's going to change bearish, right? Changes bearish on H4, but it's just a quick bearish, so it's just daily pullback. And then when the next daily leg is going to happen, what is it going to 4-hour do? 4-hour shifts bullish, and it can even take it to the next level. That daily trend is what? It's one big weekly trend. Let's change the color. That can a bit confusing and get your head around it, but that's how the market is fractal. This happens with every single time frame. If you go down and go up, it's the same relationship. Now, you don't need to be managing or even analyzing many time frames. Okay, it can get very confusing, quite advanced stuff. But in my opinion, you only need 3 time frames. If you really understand 3 time frames, it's pretty decent. We can even drop it to 2 time frames. So uh, we call it the 3 time frame philosophy, right? So you have a higher time frame, you have a medium time frame, so MTF, and you have a lower time frame. Now, really, it's just the higher time frame and the medium time frame is where we do 95% of the analysis on the higher time frame and the middle time frame, gives us our trade ideas and the market direction. and we only use the lower time frame to enter. So let's go through this. This should be our 4-hour chart. And again, just thinking of swing structure, forget about the other types of structure. So we got a bullish 4-hour string structure, and we got a 4-hour boss to the upside, right? What do we expect after 4-hour boss? We expect a 4-hour swing pullback. Okay, so we know that. We know 4 hours bullish. This is 4-hour range. Now, if we're expecting a 4-hour pullback and we want to use multi-time frame analysis to help us time when the actually pullback is going to start, we can jump into our medium time frame, which is the M15. And what I'm looking for is on the medium time frame is I'm looking for the M15 to shift bearish. Okay, so when it shifts bearish, which is the thin gray line, now I know that I can follow this M15 trend. Um, but what is the objective of that point? We are just playing the 4-hour pullback. Even though I know that I'm following a bearish trend, I know that the 4-hour is bullish, and I know that I need to be on my toes because it's going to shift bullish again, and it's going to go again towards what currently exists as the bias on the higher time frame. Once that occurs, I know the 4-hour pullback is finished, and now it's daytime to target the 4-hour high. So this is follow this bullish structures and buy it from the strong lows, target the weak highs all the way until we actually take the 4-hour. And then what we do, we're going to repeat the exact same process. We're going to go 4-hour boss, wait for the M15 to shift bearish, M15 shifts bearish, 4-hour pullbacks kicking in, M15 trend until we come into the 4-hour low, wait for it to shift bullish, and let's run. And we keep repeating this cycle over and over again. So for me, these two time frames are the most important, so I can identify the narrative, how I get the actual time frame of the session and the bias. And then the medium time frame is the most important, where I actually have my supply and demand zones, where I'm looking to time those trade ideas. Can get into the next lesson. Okay, when price pulls back down, let's imagine it come down into here. Your medium time frame shifts bullish, comes down into your M15 zone. I want to get long in here, and as soon as price hits that area, drop into the lower time frame and wait for my mechanical entry model to get long and target the next move. Okay. One thing I want you to take from this is you have your higher time frame and your medium time frame, and they are what you use to get your market direction. Medium time frame is really the most important. Maybe you just follow one time frame, but what a higher time frame allows you to do is that it helps you to know when your medium time frame is going to change trend. Okay, because imagine that you were looking at the M15 and nothing else. So it's just M15 is bearish, and just keep shorting and shorting and shorting. That's fine, and you'll probably be profitable. But now imagine that price is down here, right, and it's coming into your M15 zone, bearish. This is a strong M15 high. This should be really high probability for it to continue down. And then you're wondering, why did it shift bullish and took me out? Because this is where multi-time frame analysis is going to help you. Because if you're looking at the 4-hour chart, you'll know that coming into the 4-hour strongest swing low, swing demand, and this is where you expect the 4-hour swing pullback is over. Therefore, we expect the M15 is going to shift bullish now. So this is not a good time to keep shorting. This is when multi-time frame analysis comes in and helps. So I hope this makes more sense. Same from follow strong structure, target weak structure. Let's look at the example on the charts. We will wrap this up and make it make sense. Here on the left side, we have the 4-hour price action, and here on the right, we have the M15 price action. So let's go through this, right? 4-hour structure is here. We got a 4-hour pullback, and we got a 4-hour break of structure to the upside. After a 4-hour boss, what do we expect? We expect a 4-hour swing pullback. Okay, so if we zoom in into where the 4-hour broke structure on the M15, get an M15 swing pullback, and then we get a break of structure on the upside. So just think about an M15 perspective. Imagine that you were looking at span this like this, and imagine that you're not looking at multi-time frame analysis, just looking at the M15. You can still be profitable if you just follow this, but keep on going and up and pull back, trying your entries and so forth, and eventually shift bearish. Okay, fine. But when, let me get a real red line. Okay, so when we use multi-time frame analysis, is really you get the trade to the next level to manage your expectations of when the actually M15 is going to reverse, when it should be aggressive, when it should hold back, how far you can target. And that's how you improve your strike rate. This is how you improve your risk reward. And this is how you have clarity and confidence of execution. So again, 4-hour boss here. What do we expect? We expect 4-hour pullback, but That doesn't mean that price is just going to pull back straight away, right? This is a perfect example. A number of days, price can keep going up. So this is where you can't choose to follow the M15, but you have to realize that at any moment, that 4-hour pullback is going to kick in, and therefore the M15 is going to change trend. So you might want to be a bit more cautious than normal, follow the M15 trend when this is overextended, because at any moment that swing trend is going to kick in. M15 chart shifts bearish, so look at our framework. This how right here, shifting bearish here. So now we want to follow the M15 trend. But what is the objective? The objective is to fulfill the 4-hour pullback. So this is what we're playing. We're just playing the 4-hour pullback down into the 4-hour demand, where we think is going to end. Obviously, we can see this with a bit of a hindsight, but this is where we're going to be targeting. So now we now know that it's at this point here, if we're our 4-hour chart, we can follow it onto the level of demand, because it's likely where it's going to pull back. When we have this price action in the M15, this for me is a very high probable conditions to get short, because the M15 is what gives me my immediate bias for the session. This is what I'm looking to follow. So when I have room now to follow this bearish structure all the way down into the 4-hour demand, it's go time. Clear objective. No significant high time frame demand to the left till we get all the way down to here. These new phases that we get, price going to come back into supply. We get a bearish in the change of character, got a fraction of supply. Price goes back into here, bang, drop down to lower time frame, entry model, and we're going to target that week low. This is the week M15 low because it fails to take out the high. So take out profits at the low, wait for the boss. We reassess. We're not shorting the other. Why are we not shorting the other? Because after an M15 boss, what do we expect? An M15 pullback. This becomes a new range. Take out the low. Price pulls back into the level of supply. We get into the back. Liquid entry model that we need, and we get in short where we target the week low. We're not chasing shorts down here. This is not what we do. That's what the amateurs do. We wait for the pullback. Liquidity gets built. We'll about that in the future. Entry right in the strong high. This is the highest probable point to get in short. What we target the week low. Price comes down into here, and if you're not doing multi-time frame analysis, what do you do? Well, the M15 is bearish. Is the M15 range. This is my strong M15 high. This is my extreme level of supply. This should interiorly be high probability to get short. I want to target at the hard end. Oh, it didn't work out. Why didn't it work out? Well, for those of you who can use multi-time analysis, you'll be wary of not shorting at this point. Because look at the 4-hour chart. Look at what we done. We pulled back down into the strong 4-hour low. This is the demand we expect should hold if the 4-hour bullish trend is going to continue. So when we're coming into this level, we get a big reaction. That's warning sounds that the 4-hour pullback is over, and we're ready to target the 4-hour high. Okay, so that allows to do two things on the M15. The first thing is that allows you to potentially get in long against the M15 trend with more confidence, because trading counter trend is harder a lot of times. So you might not want to trade against the M15, but if you can see that we're in a good area of value in the 4-hour chart, you will have confidence to do so. Second thing is that you want to trade pro M15 trend, but you recognize this is not the time to try and short here, because of the 4 hours showing me that the M15 is going to shift bullish. And that's how you start to bring those time frames together. So these are my main two time frames where I spend 95% of the time looking at it. And when I'm happy with the narrative and story that I've built, going to the M15 zone, then I jump them into the lower time frame and I just jump into the position. That's it. And this is as simple as you can keep it. Now, it doesn't mean that it's going to be easy. Please do not misinterpret me for saying trading is easy. This is one of the harmless things that you will ever do. But when you know this framework, it's going to help you so much, right? Not every day is going to be a great price action. Not every day is going to have a clear bias, but that's okay. But the art of trading is when you have a clear bias and thing aligns, like in this example. This is a clean example, so I can explain the framework. But you'll have to then to have the confidence to put your foot in the gas and get involved. And these are times where you have to not be scared of taking losses. And that is why I found in my trading that allows you to have a good year, and what allows you to have a bad year. You don't dig yourself into a hole when the market is messy. Okay, there's no clear directional bias. I'm not trading today. But when there is, you jump in. When it's clear. Bit of side lessons there, but I just wanted something I wanted to share from my experience. So let's wrap this up, right? So kind of down in here, we expect the 4-hour pullbacks over, and now we're expanding it. Next leg's going to be to the upside, right? We wait for the M15 to shift bullish. Okay, now if I zoom out, M15, we can look into that. Zoom out, and you can see how this is good way to do it. This is 4-hour range. M15 shifts bearish to facilitate the 4-hour pullback, pull all the way back into the list level of demand. Now we expect the 4-hour to be complete. Now we need confirmation, right? We get that at this point, shifts bullish here. Now we have a right conviction that we expect the M15 to now stay bullish until takes out that 4-hour high at least. So at this point, what we can do, can mark a new range. This is our new range. This is a strong low because it took out the high. Now price is pulling back. We know that we can play the pullback, but price should not break this low. Then we pull back into the next level of demand, pop up, gives us a fresh level of demand signal that this pullback is over, and a lot of lines. M15 boss, M15 pullback into demand this level, and we get a strong reaction and exchange of carry to the upside, and creates a fresh level of demand. Great entry there. Now we have alignment, and there we go. At a given point in time that has kill zones. Let's get involved. Break of structure, sweep liquidity, maybe a tricky one to get involved, another leg up. Fresh level of demand, boom. That's a clear trade now. Target where? Target the next high. This is how you build a narrative. Again, you're going to learn how to do this with supply and demand and how to time it with liquidity. But you see how all comes from market structure first. And this is the most important thing. Follow this bullish internal ranges that try to break the low, fails go below, and we actually continue bullish. Now a really good trading opportunity right here with our model, and we got a nice trade. We can target a high and beyond. But really, if you take anything from this, it's just understanding that framework. Okay, lower time frame fulfills the objective of a higher time frame, and when the pullbacks shifts bullish, and we can actually follow the internal structure all the way to the highs. Does that mean that we're going to buy? No, we don't buy every high and low, but this is the start how I actually will understand and how to actually look into interpret the market structure. So follow the order flow, follow the higher time frame narrative, and that is how you end up in the right side of the market far more often than not. Bit of a long lesson. I hope you guys survive from that. And the next one we're going to lay over into institutional supply and demand, a few secrets and tricks. We pick up in the European Central Bank, pick up liquidity concepts, and start looking at trade patterns and even more advanced concepts. Guys, enjoy. Stay tuned.